Welcome to AHA Math and Science. In today's video, we like to examine the correlation between federal funds rate, the inflation rate, and the stock market. So the federal funds rate, is the price of money. And recently, the Federal Reserve has raised the voice of hiking the rates, or more hikings, and also holding the rate at a high level for a long time. And this has already caused volatility in the stock market in the past few days. Well, here is a chart of the federal funds effective rate in the past 6 decades. You can clearly see that these peaks associated with each of these cycles. So the 1966, the 1969, the 1974, the 1980, the 1989, and also the 2000, the recent one, and then the 2008, and another one, 2019, and the current one is with which we are experiencing now. So the rate, which affects really the price of everything, including the interest rates on credit card balance, the mortgage rate, and certainly the prices of various assets, including equities, housing, etc. So it is really the price of money. So, but this important sort of factor in the financial world, perhaps the most important factor in the financial world, is actually driven by something even more fundamental. That's inflation. So whenever we have a high inflation, or the inflation starts to kind of pick up and skyrockets, the Federal Reserve has to react. And then the most sort of response is just hiking the rates. So for example, in 1974, the rate goes up from above 12.5%. It's driven by the so-called oil prices. So at the time, due to the oil crisis, you cannot really even fill your tanks. And you can see that in this photo, December 23rd, 1973, these cars have to line up at the gas station in New York City to fill the tanks. And fast forward for 5 decades, now we are in another inflationary period where everything is going up. The price of everything is going up. And you can see the empty shelves in the X section of a supermarket. And you can see the just kind of ever soaring prices of all the eggs. So this is obviously has causing a lot of problems for like just the everyday life of people. But the inflation now is still kind of going down, but the Federal Reserve is still on this sort of hiking path. So it's interesting to actually put the federal funds rate and the annual inflation rate together on the same chart and to do a comparison. So here is the data for these two rates over the past 6 decades. You can clearly see the two rates track each other very closely. And another thing we want to note is that prior to the 2008 financial crisis, you can see the federal funds rate, which is the blue curve, is usually above the annual inflation rate, which is that curve. But after the financial crisis, you can see most of the time, the inflation rate is above the federal funds rate. So this obviously is perhaps one of the main drive for the soaring asset prices. Like stock market is booming and housing is going up during since the great financial crisis. But we also note that before the great financial crisis, you can see pretty much the federal funds rate kind of track the inflation rate in sync. Basically, the two rates go up at the same time. Or even sometimes the federal funds rate go up before even the inflation goes up. But the story is different for the present time. You can see the inflation picked up at here. But then the federal funds rate did not respond almost like 2 years later. So there's a huge delay, and that's causing some problems, and perhaps causing that the Federal Reserve has to hike the rates more, and then have the rates at a high level for a long time. And in this analysis, we are interested in actually look at the timing when the inflation peaked, for example, here, and then when the federal funds rate peaked, and the timing between these two peaks. So here, in this case, in the 1974 case, the inflation peaked in December 1974, and then the federal funds rate actually peaked a few months before that. And then in another scenario, in the 1980 case, the inflation peaked in December, actually March 1980, and then the inflation did not peak like until like a year later, more than a year later. And then the current situation is the inflation peaked in June 2022, but we don't know when the federal funds rate will peak. So there's these many different situations. And even more interesting is to actually also plot the stock market, the SP 500 in this case, to represent the broad market. Now we have scaled it by a factor of 25 so that we can plot all the two rates and the SP 500 index on the same plot. And this is the vertical axis is not in a log scale, so we can actually see the ups and downs very clearly. You can see pretty much every inflation period. The 1966, you have a bear market, and this is the bottom. This is the 1969 inflation, and that's the bottom. This is the 1974 inflation, and that's the bottom. So pretty much for every case, you have a market bottom. In the 1974 case, you can see actually the market bottom even before the inflation peak. However, for the 1980 case, actually the inflation peaked at here, March 1980, but the market didn't bottom until sometime in 1982. So there's a long delay here. Now, in our current case, inflation already peaked in June 2022, but we don't know when the market whether the market already is bottom or when it will bottom. But we do know that the market topped in January 2022. So there's a lot of information here. And we also want to point out that, through all these different inflation cycles, there are two, I guess, periods we want to just point out. And one is actually in 1990 when the inflation peaked, but there's no bear market. So we're not going to include this analysis, the analysis of this cycle in this video. And then another one, which is very special, is during the pandemic in 2020, when the market, we had a bear market, but the inflation actually barely kind of peaked. That's very special. So we are not including this cycle in the analysis either. So there's, other than these two, there are 7 very clear inflation periods, and then the bear markets associated with each inflation period. So we're going to analyze this. So put all this data into a table. This is what we have. This table has a lot of important information. We're going to walk through the table. So the first column is the time when the inflation peaked, including October 1966, March 1980, and the recent one, June 2022. This is the rate when the inflation peaked. So we have really high inflations in the 70s and the early 80s. And then this one is also pretty high for the recent one. And this third column is very important, interesting, which is the time from the peak inflation to the first rate cut, when after the rate already topped. So measured in months. So in some cases, you can see that the Federal Reserve made the first rate cut even before the inflation peaked. And then in other cases, the Federal Reserve waited quite some time before they make the first cut, after the inflation has already has peaked. And then this column is what we are also very interested, which is what is the time from the peak inflation to the market bottom, measured in months. In some cases, you can see the market bottom at the same time as peak inflation, or even before the inflation peak, it's a negative value. And in other cases, the market bottom long after the inflation peak. And then this is the duration of the bear market for each cycle. And this is the drop from peak to trough for each bear market. The last low is basically the current cycle. You can see the Federal Reserve has not made a rate cut yet. And it looks like it's not going to do a cut in March 2023. So we will say that the time from peak inflation to first rate cut, at least more than 10 months. And what about the time from peak inflation to market bottom? Well, it at least to be more than 4 months. If the October low, October 2022 is the low, market low, then it's going to be 4 months. But if it's not, then it's going to be more than that. And then the corresponding duration of bear markets is just this number is based on the October 2022 low is the bottom, but we don't know that yet. And same thing here. The 25% drop is based on the October low, but we don't know that information. If the market bottom is not in yet, then this number would be also bigger. So you can see that from this table, that these two sort of lows kind of stand out. This is when the Federal Reserve wait quite some time before making a rate cut. And then corresponding, you can see the time from peak inflation to market bottom is more than 2 years. Or in other cases, Federal Reserve either cut the rates way early, before even the inflation peak, or just a little bit after inflation peak. Then it does not take a lot of time for the market to bottom. So let's actually plot these two columns on a plot. We plot the time from peak inflation to market bottom versus the time from peak inflation to first rate cut. And let's see what the chart tells. So the horizontal axis is the time from the peak inflation to the first rate cut. And then the vertical axis is the time from peak inflation to the market bottom. So you can see the data kind of fall into two categories. One is the Federal Reserve made the rate cut even before the inflation peaked, or right at the time when, or just a little bit after the inflation peak. And then it does not take a lot of time for the market bottom because these are small numbers. This is like the market just bottom when the inflation peak. This is like 8 months after the inflation peak. But then in two cases, which is up here, is the Federal Reserve made the first rate cut, quite some time after the inflation has peaked. And then you see it takes a much longer time for the market to bottom. So what about the current case? Well, unfortunately, right now, the Federal Reserve has not cut the rate yet. So it's already 9 months, and it's not going to cut in March. Then it's going to be in April. If even April is the first cut, it's going to be 10 months after the inflation peak. So we are at least on this side. Our data point cannot be on the left side. Another thing that we note is that if we draw a diagonal from the lower left corner to upper right corner, data points on this red line is basically, it takes the same amount of time for the peak inflation to first rate cut versus the peak inflation to market bottom. In other words, the market bottom at the same time as the first rate cut. But there's only one data point below that. Most of the data points is above the diagonal, meaning that from the time from peak inflation to market bottom is usually longer than the time from peak inflation to the first rate cut. In other words, the market bottom quite some time, or at least after the first rate cut, but usually after a delay. There's quite a delay after the first rate cut and the market bottom, because this is when actually the market bottom at the same time as the first rate cut. Points above it is you had to wait a little bit, or even sometimes several months, or even like years before the market bottom. So in the current case, you can see that we are definitely going to be kind of being confined by these two lines here, because the Federal Reserve has to cut at least make the first rate cut at least 10 months after the inflation peak. So we're definitely on this side, but then we don't expect our data point is going to be below this red line. At the most, it's going to be just on the red line. Most likely it's above it, because you can see these two data points. Whenever Federal Reserve has to wait before the first rate cut, even long after the inflation peak, it usually means something is sticky. So therefore, the Federal Reserve cannot cut the rate. In the 1980 case, the inflation is very sticky, which is data point. This is the 2000 dot-com bubble. There's a lot of inflation in the asset price. So the Federal Reserve cannot even make the rate cut. Well, there could be other reasons, but as long as the Federal Reserve cannot make the rate cut, soon enough, then it's going to create a problem. Right now, the Federal Reserve cannot cut the rate because the inflation is very sticky. So most likely, we are kind of like around this line here. So the most optimistic case is kind of fall on the red line, which is still like, at least it's going to be 10 months after inflation peak. So the market bottom will not be in at least 10 months after the inflation has peaked. So in conclusion, that it's not likely that the market low we have seen in October 2022, which is just 4 months after the inflation has peaked, is the low for this bear market. So probably we have to still wait some time for the low to be in. So that will be the main kind of take-home message for this video. So I hope you have enjoyed this video and find the information presented here interesting. If you enjoyed, please do not forget to click the like button and also subscribe to our channel, and so that you can watch more videos like this one. And thank you for watching.